This is Fintech Insider News, and this week, Barclays completes the purchase of Tesco Bank, US buy now pay later giant Affirm is coming to the UK, and America has a new president. Here's how Fintech reacted. We'll be discussing all of this and more on today's show, so don't go anywhere.
Kroger Delivery has one mission: to deliver the freshest food right to your door. That's why our drivers are pros. Our trucks are refrigerated. And when it comes to low prices, we always deliver. With $20 off your first order of $75 or more, there's no better time to get in on the action. Mission accomplished. Restrictions apply. See site for details.
Hello and welcome to episode 913 of Fintech Insider. I'm Laura Watkins, Director of Media and Marketing at NatWest, and I'm joined this week on Fintech Insider News by some great guests who are here to break down the biggest stories from the past week in fintech and financial services. First up, we have my 11FS colleague and co-host for this podcast, Benjamin Ensor, Director of Research and Strategy at 11FS. How are you, Benjamin? It's always great to work together. I don't know if we've ever actually podcasted together.
I don't think we have, no.
This is very nice. Without breaking any NDAs, can you tell our listeners what you've been working on recently?
Yeah, the team's been up to a whole bunch of things. We've just published a report, which some of our listeners probably know, on how to take open banking payments mainstream in the UK. We've been working with a North American credit union, helping them think through some new propositions for their customers. We've got another project going on where we're doing some really interesting sort of consumer testing or customer testing of a whole bunch of innovative ideas. And then we're doing some service design work, thinking through what the sort of service blueprint looks like for a capital markets firm as things like automation and AI change the roles of people in their workforce. So some really interesting and challenging pieces of work going on in the team.
Absolutely, loads going on. And yeah, really exciting to get that Go Colours report out in the world. We quoted you in your absence on this podcast when you were reported in a publication saying that open banking is a truly terrible name, which got some traction.
I think I said it was bloody awful.
Okay. and you stand by that, I'm sure.
People don't know what it is. Ordinary people don't know what open banking is. And if you're trying to market something to normal people, use a name that people can understand.
Absolutely. And if you want to know more about that, look up the report on 11fs.com. But enough about us. It is a warm welcome back to the podcast for Mariela Hunter, a fractional COO. It's been a busy year of M&A action, so it's great to have you back on the podcast to tell us all about it. How are you?
I'm doing well. Thank you so much for having me again. Post-election day, I've been in the pod a few times. And for those of you who don't know me, I've over a decade of experience in financial services across UK, US, both large banks and more recently fintechs. My expertise is across strategy, deal making, transformation, and as we're going to discuss, M&A partnerships and also in corporate ventures. Fractional COO, and I'm helping fintechs, health tech, SaaS, venture-backed companies with automation flows, AI into the tech stack and embedding AI agents, more recently in the neurotech world. And I'm excited to dive in today.
Amazing. Sounds like you have plenty going on. So thank you so much for making time to join us today. And last but not least is another welcome back to the podcast to a familiar voice for our listeners, Jason Mikula, founder of Fintech Business Weekly. Brilliant, as always, to see you, Jason. How are you doing and where are you joining us today?
I am actually back at home in the Netherlands, which today of all days, we're recording this the day after the U.S. election. I'm kind of glad to be here. And I think since the last time we spoke, I actually started a new role in addition to continuing to publish the newsletter as the head of industry strategy for banking and fintech at next generation decision platform Tactile, which allows customers to build, iterate, and collaborate on automated decisions across every kind of use case.
Amazing. Well, congratulations on the new role. And as you say, we are recording this on a Wednesday. Unusually, normally we record on a Thursday. But yes, it is Wednesday the 6th, which means naturally that our top story this week is the US election, as you mentioned. So what does a Donald Trump election victory look like for fintech? So here we go. Donald Trump is set to make an extraordinary return to the White House as the new president of the United States. This will be Trump's second term in office following his 2017 to 2021 presidency. US voters have elected a Republican majority in the Senate, meaning that they can exert significant influence over national policy. Markets reacted positively to Trump's expected win. The dollar index hit a 4-month peak and Bitcoin hit an all-time high. So what do we think a second Trump term in office might mean for financial services? Benjamin, do you want to kick us off with your initial thoughts?
Yeah. So, I mean, this is huge, obviously. The first thing to say is, instead of going to prison for a felony that he'd been convicted of, Donald Trump now becomes president and can pardon himself. That has huge implications for the world economy, for world peace, and of course for financial services. So I think the sort of immediate impact is, yes, great. There's some buoyancy in the American markets. The news has been received positively by the markets. There's good news for fintech in here, but there's also bad news. And it really depends a little bit on who you are, because the outcome is likely to be good news for some groups and bad news for other groups. And I think we'll probably dive into some of those different groups are. But I think it's a mixed picture. So, as always with any election, you get winners and losers. But if we look at what Trump did last time, with big tax cuts for the wealthy, my hunch is this is going to be good news if you're already very wealthy, and maybe not such good news for more ordinary people. But I'd be interested to hear the take from the other two.
Yeah, absolutely. And coming to you, Jason, you've kind of already made some allusions to where you stand on this issue, given that you're happy to be in the Netherlands, your words. But what's your take on this?
Yeah, so as I was preparing to record this today, I wanted to look back at some of the appointments in Trump's first administration. And to fully caveat, I was not paying, nearly as breathlessly close attention to sort of day-to-day regulatory affairs in that period, which is like 2017 to 2021. But if you think of, the phrase personnel is policy, sort of who you're appointing to these agencies is going to have a very strong impact on shaping what rules, if any, are formulated and finalized. What does enforcement look like? And while his appointments to, the Federal Reserve, Fed Chair Powell is still in that role today, right? Biden reappointed him to a second term. Joseph Otting led the OCC, so the national bank regulator for the majority of Trump's administration, followed by Brian Brooks with a brief term. You had Yelena McWilliams at FDIC. If that name is familiar, it's because she's the trustee in the Synapse bankruptcy. Perhaps the most extreme appointments were at the CFPB, which has always been kind of a boogeyman for Republicans. Most memorably, you had Mick Mulvaney as the first appointment to that consumer protection regulator, who described the agency as a sick, sad joke and requested a $0 budget. Although eventually he went and became, I think, simultaneously the director of Office of Management and Budget, as well as one of Trump's chief of staff. I can't remember first, second, third. And he was followed by Kathleen Kraninger, who was, certainly more conservative, but a pretty typical sort of Republican mold regulator. This time around, I'm not necessarily sure that this is the kind of cast of characters we're going to see. Obviously, it is, the earliest of early days. I did spend a little bit of time today reading Project 2025, which does contain some relevant sections, which, we'll see if we have time to sort of wade through how that may shape what this administration and their appointments look like.
That was a pretty comprehensive breakdown already, so I appreciate that. Mariela, what was your take on this? Sort of, Jason mentioned the CFPB. Do we think we'll see any changes to that, or any of the kind of regulatory rollbacks that Trump sort of did first time around and has also kind of promised to do this time around as well?
Yeah, I think looking at the chart, fintechs, banks, there's two mandatory topics here, which are around the interest rates, particularly prime rate, and then, yes, from the CFPB, the final 1033 rule. But I just want to call out one thing that you guys have mentioned, which is interesting. You know, in tech, we do A/B testing. And for this election, we have the ability to look at the last two periods, the Trump presidency 17-21, and we can look at the recent Biden administration, look back at performance and make a decision, which is, you know, a really good position in terms of making a data-driven decision based on performance. And one thing I want to call out quickly before jumping into the key point that, you know, banks are focusing around the rates is that, yes, as you look at the comparison of performance, if you take something like GDP during the previous Trump administration, the rate around growth was around 2.3%. And you look at Biden now, as of Q3 2024, is 2.8, but that's adjusted for inflation. The one thing I want to call out is that everybody's looking at the macro picture and seeing a trend that looks broadly trending positive or stabilizing. But there's a big dissonance between what you hear at the macro level and what you see in the earnings reports and what you see particularly in health tech, SaaS, fintech, which is a headline around softening of demand. So part of that, the softening of demand across the board is driving a lot of companies towards increased levels of efficiency. And this is why, I've been so busy with automation, embedding AI into tech stack and rolling out AI agents. These levels of previous efficiency through digital transformation are not enough. They're taking a whole new level because of that. So I just want to call out there's that difference, and also an analysis that backed out of that percentage of the GDP, what is the government consumption? And that was a large proportion of the economic gains around the last 2 years. Actually, it was around 80% attributable to government consumption. It was not industry. So what you actually see is a normalization of that view and a flatter economy. But the big conversation right now across banks is, of course, around the interest rates. The Fed cut down rates by around 50 basis points, but the 10-year Treasury is around 4.3. But what really hits home for fintechs and banks is the prime rate. So it hit 8%. And that really hits home for consumer, because they think about it. If you wanted to buy a house or pay down debt or refinance debt as a corporation, you could do that before around 4.3%. Now your debt service costs twice as high. What that means for the consumer is servicing debt is twice as high. The purchasing power of consumers is halved. So think about the trickle effect that will have on credit card, corporate debt, corporate credit line utilization, and so forth. And of course, this is the financial complex formula playing out. The cost of borrowing climbs, new debt has to be ratioed at a higher rate. So expenses to pay interest rate is higher, which means taking on more debt to pay the existing debt. And it's this sort of the compounding problem. You can't get away from the debt spiraling software running through the system. But with the fintechs, the key chat that I'm hearing is around concerns around a credit crisis. Okay, and this is all connected. The last point, I think, which was alluded to, Rule 1033. You recall October, the CFPB, folks that are less familiar, Consumer Financial Protection Bureau, released the final 1033 rule that sets out the guidelines for consumer control of their banking data, as well as the guidelines for how banks store, manage, and how they make the data accessible. This is key, of course, between banks and fintechs, because you're using the likes of Plaid, Yodel, MX to connect consumers to fintechs, challenged heavily by industry. But my reading, welcome your thoughts here of the panelists, it's unlikely to change because it's bipartisan, but it also seems to be a populist vote. So it doesn't look like we're moving away from it. What do you guys think?
Yeah, I agree. I think it's one of the things that may not change. To your point, it's quite bipartisan. It's also quite hard to turn around to the people who've just elected you and say, hey, I don't think you have a right to your own banking data. So I think that's one of the few things that may not change from a regulatory standpoint. But Jason, you may have a very strong different view.
No, I think that's generally correct. I mean, while Mariela's point that, industry, particularly the largest banks, are not necessarily thrilled as 1033, has been finalized. And you've seen that in the form of a lawsuit actually filed the same day that the rule was finalized by the Bank Policy Institute, the Kentucky Bankers Association, and some tiny bank in Kentucky, the name of which I am forgetting. But the BPI, the Bank Policy Institute, basically represents the interests of the nation's largest banks. So I think it's fair to say that large banks are not, super thrilled with what they view as some of the potential risks, both as far as, potentially either losing accounts, losing deposits, or needing to pay higher rates to maintain those deposits on that side of the balance sheet, as well as the opportunity to have users more easily and seamlessly either refinance debt to lower rates or find sort of like better deals on products. That said, the reception in Congress, specifically around 1033, has been generally quite bipartisan. And so while there are mechanisms, specifically the Congressional Review Act, by which a new Congress can reach back and invalidate rules passed by prior administration agencies, or I guess also current administration. And that did happen at the beginning of the Biden administration with the so-called True Lender Rule, which the new Congress used that power, the CRA power, to invalidate. I don't think it's particularly likely to happen for 1033. That said, the court challenges, will still play out, so...
I think some of the changes we might see are in some of the other areas. Trump has a history of deregulation. He's promised deregulation. And that means things like the Credit Card Competition Act, which was going to bring in, more caps on US credit card interchange fees, which much of the rest of the sort of Western world has, that becomes quite a lot less likely to happen. And as we see deregulation, we talked about the Consumer Financial Protection Board. If we see that, having its sort of teeth removed and not taking action, my concern is, does that get us to the point where we get more fintechs coming in that maybe haven't got customers' best interests at heart and not well run, and then we end up with another FTX, another Synapse type situation? I think Jason doesn't know much about Synapse.
No, I don't know who we should put that question to.
Actually, yeah. A very quick clarification on the Credit Card Competition Act. It's not that it caps interchange rates. Rather, it is a requirement for very large banks, I believe those with over $100 billion in assets, to support two unaffiliated card networks. So it's not a cap. The idea, this is very American.
Misunderstood.
Very American. The idea is that competition that you have between, Visa, MasterCard, and some other unaffiliated network will increase competition and cause that interchange rate or the total, fully loaded swipe fee or merchant discount rate to be lower. It's unclear whether or not that would actually happen that way, right? When the Durbin Amendment passed in, part of Dodd-Frank back in 2010, those savings did not, end up in consumers' pockets. So I also tend to agree with your point that the CCCA is generally unlikely to pass, although we don't know the makeup of Congress, specifically the House side, as we're recording this. Although I would point out, there are some interesting sort of, we talked about I heard the word populism or populist earlier. There are certainly some sort of populist and anti-corporate wings of the Trump coalition. This didn't get a lot of coverage because I don't think anyone took it seriously, including me. But at some point in the last, couple weeks of the campaign, Trump floated capping credit card interest at, I think, 10%. Now, there's about a 0% chance of that happening. But, what constituency was that designed to appeal to? People who are carrying credit card balances and maybe, struggling to manage debt. So there are some wild cards here that I think is, difficult to predict. I feel that's a understatement of describing Donald Trump. Difficult to predict exactly how this is going to play out from a policy perspective.
Yeah, I think unpredictable and populist also is a good summary of like the support that's been thrown behind crypto as well as part of this. So the quote, they call me the crypto president, and promising to make America the crypto capital of the planet and creating a stockpile of Bitcoin. I know that's words, right? But Bitcoin has spiked as a result of that. And how seriously should we take that? I know that's probably not the biggest issue of the day, but it is an issue.
I will be more brief than my last answer. Donald Trump has basically fully reversed on that position, and I think it's not too big of a leap to understand why, as far as appealing to certain constituencies, voters to ultimately win the election. I do think that is the U.S. going to create a strategic stockpile of Bitcoin? Like, why would that happen? I have no idea. What would the purpose be? I don't know. The place where I think you are likely to see a big impact, both Trump and the Senate, and depending on what happens in the House, is around some kind of presumably like quite industry-friendly regulatory framework, right? We've seen particularly entities like Coinbase clamoring for this. The extreme sort of dislike of Gary Gensler, the current SEC chair, as far as his quite staunchly anti-crypto positioning. And so I would expect that, particularly depending on if the House also goes Republican and you have unified control of government, that is an opportunity both on the sort of classic crypto side, Bitcoin, as well as stable coins, which are receiving a lot of attention and focus across the spectrum lately, including from more sort of traditional banks or like bank-adjacent service providers. So I would expect that is the place where you see the most activity.
And I think we will have to move on, otherwise this entire show could be this. But before we do, let's just take a very, very quick temperature check from all of you. Quick fire. Is this appointment going to be good or bad for the industry? And I'm putting you on the spot here. Jason, do you want to start?
Short term, probably good in a relatively narrow sense. I think in the medium to long term, the challenge is these things are oscillating back and forth between every administration, and that does make it very challenging to plan, run, and operate a business if things tend to sort of dramatically reverse from a regulatory perspective when there's a change in administration.
Fair. Mariela, good or bad?
I think it's a very mixed view, depending on which angle you're looking at specifically. Yeah. So I can't give you a holistic one on this one. But I think there has been a lot of shifting positions as he led towards the election. So that means that things can continue to change, even some things that have already been set pre-election. I think in terms of the watch out, the key one will be around the economy and rates. I think the regulation is a key one that is expected from Trump, a more relaxed environment, which has both positives for fintech, but also some potential consequences from a consumer perspective, potentially. And I think the watch out now is around how the fiscal policy, economic policy is going to play out in the near term, given the huge risks that banks are facing in their balance sheet. So I don't know to what extent that's under Trump's discretion versus other powers, but it will be interesting to see how that plays out.
Absolutely. And I realize it is a question with zero nuance on a very nuanced issue, but I'm going to put you on the spot as well. Benjamin, what do you think?
I broadly agree with Mariela. I think, short term, it's potentially good news for some US fintechs, particularly crypto and so on. As you see some deregulation, it enables you to sort of innovate faster and so on. And that's all good. But then you hit this point where the absence of regulation causes bad things to happen. Consumers don't get protected and the industry gets a bad name. I think the bigger picture thing, though, is what else does Trump do, right? Because we are in an increasingly unstable world. We have the sort of the war in Palestine and in Israel, Gaza continuing. We have the war in Ukraine. We have instability in Sudan and so on. A more isolationist US, potentially encouraging China to invade Taiwan, etc. anything like that is incredibly bad news for industry at large, the world at large. So, yeah, there's some good news short term. Long term, I think this is quite bad news for the financial services industry because there's a lot of instability. Some people will make a profit from that, and a lot of other people will lose out.
Well, on that slightly doomful note,
Sorry.
we will be obviously keeping an eye on this and bringing more updates as they come. Obviously, this is less than day one into the new presidency, so we are kind of hypothesizing to a degree, but we will keep everyone updated as we go on. So on to our next story. Buy now, pay later giant Affirm lands in the UK. The story was in Finextra. So the major buy now, pay later platform from North America is entering the UK market with both FCA authorization and launch partners, flight booking site Alternative Airlines, and fintech and payments processor Fexco. Affirm differs from other buy now, pay later services by offering no late fees or hidden charges and individually underwriting each transaction for responsible lending. The company is expanding its UK team, currently at 30 employees, to support its operations, and it also has backing from both the UK government and Investment Minister Poppy Gustafsson. Affirm's entry coincides with the UK's move toward tighter buy now, pay later regulations under the Consumer Credit Act, aiming to increase consumer protection in this rapidly growing sector. So what do you make of this, Benjamin? US fintechs launching in the UK. We've had quite a few of those in the past 18 months, including Alloy, Robinhood and Public. What is it about the UK that kind of makes this an attractive market for Affirm to make its move?
We speak English.
Good start.
I'm joking. I mean, though that is a factor.
Yeah.
One of the other factors, though, is British consumers generally are more open to new propositions than some other Europeans. If you go to a big market like Germany, which is a very attractive market in many ways, consumers there are very, very conservative. So it's harder to get a new fintech proposition off the ground. So a combination of language, strong regulation, established fintechs and a relatively sophisticated set of customers makes the UK quite a good market to launch new propositions into. The flip side, of course, is there's already quite a lot of good propositions in the UK, more so than the other big Western European markets as a whole. So it's a little bit, the competition's a bit tougher, but the customers are a bit more open to the proposition.
Yeah, absolutely. You mentioned that competition. Like Klar is obviously like the enormous player in the UK and across Europe. Mariela, what's your take on this? Are they planning to directly compete with Klarna? Obviously, one of their big sort of USPs is the no late fees, which Klarna does actually have. How do we think this kind of competition is going to play out?
Yes, I love this question. I think Affirm will compete with Klarna in a few ways. But let's not forget that Affirm has established relationships with global giants like Amazon, Shopify, Walmart. There's chat about Walmart gaining a foothold in the UK market in the e-commerce space. So let's not forget, those massive relationships and the impact that could have, in terms of partnerships and penetrating the UK market. I think you touched on the differentiation of the product offering will be a key part of its strategy, emphasizing unique features, particularly longer payment plans. Up to 36 months is what I hear, apart relative to what Klarna is offering. And I think Affirm will need to position itself as a more transparent, more consumer-friendly option by not charging late fees, but also they're more transparent when it comes to hidden charges. They have the ability for you to calculate interest only on the original loan amount without compounding. So those are some of the differentiation tactics that they're bringing into entering the UK market.
And Jason, what was your take on this? Is there sort of any difference between the average kind of US, UK consumer that they might have to think about? Are like people going to engage with buy now, pay later in the same way, do you think?
I think generally, yes. I think there's a variety of reasons why, U.S. companies, why the U.K. is often sort of the first port of call for international expansion. I believe Affirm already operates in Canada, although actually having worked myself at a company that launched in the U.S. and then expanded to Canada, UK, and Australia, in sort of the overall P&L of the firm, and it was also a lending company. Canada and Australia were like rounding errors, just completely irrelevant. No offense to those countries. It was really just like get myself in trouble. Just from a sort of size of the economy and impact on the business perspective, the UK was just orders of magnitude, more significant. And I do think, to your point, consumer behavior, not that it's identical, but it is, arguably, I guess, maybe apart from Canada, the most similar. I mean, something that struck me just as like a personal anecdote when I lived in London, I worked for a lending company there, and use of consumer debt, I would say, was like quite comparable to how households and consumers in the US use debt, to the point where, many households struggle with over indebtedness and things like short-term loans, payday loans, cash advance, etc. When I moved to the Netherlands, one of the things that shocked me as a financial nerd and American was no one uses credit cards. And so you can imagine if your primary business is lending, and that Affirm's primary business is lending, it's going to be easier to go to markets where people are already comfortable taking on debt. And Benjamin, to your point, a country like Germany or Netherlands, consumers just don't use consumer credit in the same way, both for cultural reasons and also sort of like regulatory and like pricing reasons.
Yeah, absolutely. And Benjamin, coming back to your point around like the UK market already being, very familiar with buy now, pay later and how it works and that kind of thing. But then equally, there is a lot of option in this market already. Like, might they struggle with that? Is like having more choice a good thing, or is there actually too many payment options? If you go on something like ASOS, for example, which has partnerships with hundreds of different things, there will be so many different ways to pay and so many different logos after the checkout. How, is that, at what point do we reach saturation?
Yeah, I mean, good thing for whom. It can be confusing when you get to checkout and there are so many options. To your point, they all start to blur into each other. And that's where I suppose things like branding become important, that trying to get people to sort of recognize your payment option as the attractive one, which almost comes back to the point I was making about open banking lacking that brand that makes it recognizable. It's also going to hinge, I think for a firm, it's going to hinge on things like partnerships, right? Because this is all about partnerships. Buy now, pay later is basically all about the merchant. The merchant is basically funding the customer's goods for a period of time. So it's all about the merchant partnership. So I think, we've been talking a lot about how a firm potentially has a more transparent offering for the customer. But what also matters here is, can a firm appeal to merchants? Can it offer them better deals? Can it show it's got better conversion rates and so on? That will have a big impact on how effective it is here. And yeah, consumers, I think once you've got more than 3 or 4 options, you start to hit sort of cognitive overload. So I think we will see some merchants saying, okay, we've tried 6 options and these are the 3 that we're going to continue promoting to our customers.
Yeah, because that promotion is going to be important. Because if you're already a Klarna user, for example, why would you switch? You already know how buy now, pay later works. You're using it. A firm are going to have to try very hard to make themselves look any different, I think. And as we did mention, sort of buy now, pay later regulation in the UK is kind of coming closer. Firms coming under supervision of the FCA and under the Consumer Borrowing Act. Mariela, what do you think the impact of that is? Do you think that kind of helps the industry, gives the customer clarity? Do they even know about it? What does that kind of regulation of buy now, pay later potentially look like?
Yeah, I think the UK market, when it comes to regulation, is definitely more proactive and more stringent. You have very specific buy now, pay later regulations taking effect in 2026, requiring companies like the buy now, pay laters to adapt their practices and potentially undergo FCA authorization. I also think the consumer, like what you guys have mentioned, is a little bit different in the UK. I think there's a little bit of a spectrum, if we can think about it in terms of consumers being debt averse. UK is definitely more debt averse than the US, certainly a lot less than Germany, but there's a little bit of a continuum if you think about it that way, which means there will need to be some adjustments around the product rollout, value prop, and also marketing. But I also think the the UK buy now, pay later market is probably more mature, more competitive in the UK because of the players have already entered the market as well as the regulation. Mentioned Klarna, Clear Play. So Affirm will need to differentiate themselves, as we mentioned, unique features. And I think the partnerships are going to be critical to gain market share.
Yeah, definitely. I mean, even Klarna, particularly is sort of assumed to be the dominant player, but they are even sort of trying to diversify away from their kind of standard offering as well. We've seen partners with Adyen. We've sort of seen them looking to kind of be at point of sale and in store and that kind of thing. Jason, can you see that happening here of like all buy now, pay later kind of following Klarna's lead as well to try and diversify, and then ultimately we end up in the same place where everyone's doing the same thing?
Yeah, I mean, we've certainly seen that with these same players in the U.S. market, right? Klarna operates in the U.S. market alongside Affirm. It entered significantly later, than when Affirm got going, and you have seen a fairly significant convergence in the distribution channels that they're pursuing, right? So, to the points I think all three of you make, yes, merchant partnerships are absolutely a key point of distribution as far as like being on that NASCAR button checkout screen alongside everybody else. But we've also seen some other avenues. You mentioned, facilitating physical, like in-store bricks and mortar usage of BNPL. Both Klarna and Affirm in the US have launched these sort of like debit card type products. I forget exactly how the terms of Klarna's work, but Affirm's, which I think they still call Affirm Debit Plus, basically allows you to use it as your day-to-day debit card, and then after the fact, choose qualifying transactions to convert into pay in time. And then, of course, there's also the relatively recent move by Apple to abandon its own Apple Pay Later BNPL offering and move to a more platform approach where it will facilitate offering other companies, and I believe Affirm already has done this, at least in the US market, offering other companies BNPL financing via Apple Pay. So I do think in the quest for growth, there has been a pressure to move beyond just that checkout screen and merchant partnership to other distribution channels. And, something that always strikes me when I look at Affirm's website or Klarna's website, they tend to look more like Amazon than they do Barclays or Chase. They're becoming shopping destinations in their own right, where if you are that sort of habitual, heavy user of BNPL plans, instead of opening Amazon or going to, H&M's website, your first port of call may be Klarna's app or Affirm's app, and really sort of building that ecosystem where people think of this, as a shopping destination and not just a button that's on the checkout.
Yeah, and that's a huge differentiation.
Yeah, and just building on that, I think it's a great point around shopping destination. I do see Affirm playing out into the in-store market. I mean, we're talking about 11 trillion market of in-store shopping compared to 3 trillion online. Massive growth opportunity, and I can see that they'll be positioning themselves to tap into that market.
I mean, with those numbers, that would seem sensible, right? But it does feel like, whatever Klarna can do, they will also do, and vice versa, depending on who got to what market first. So we will have to wait and see. But on that note, we are just going to take a quick pause. Back very shortly.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's vanta.com/insider for $1,000 off.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes per detail.
Welcome back. Before we get back to the news, we wanted to share some news of our own. The 11FS Awards took place in London on Thursday night, where the best of financial services came together to celebrate the people and companies that have pushed the industry forward over the past year. We crowned 10 winners across 4 main categories: customer, purpose, technology, and impact. And we welcomed Romy Savova, Ashok Vaswani, and Patrick and John Collison to the 11FS Hall of Fame. To learn more and check out the full list of winners, head to 11fs.com/awards right now. Back to the news. And our next story is that Barclays completes a £600 million Tesco Bank takeover. This story was in City AM. It's a done deal. Barclays has bought Tesco's banking arm. Tesco will now continue to offer capital-light services such as insurance, ATMs and travel money while focusing on its core retail business. Following the takeover, Tesco announced a £700 million incremental share buyback for shareholders to start once its current £1 billion buyback program ends. Both companies see the acquisition as a way to enhance financial services for their customers, combining Tesco's Clubcard loyalty benefits with Barclays resources to better serve UK households. Mariela, you are our M&A expert. What's your take on this? Was there any likelihood that this wouldn't go through? What's the kind of benefit to Barclays or indeed Tesco's for this one?
Not surprising at all. And I actually believe we covered this last time I was in the pod.
Oh, really? That wasn't a very original booking of us. Sorry to make you repeat yourself.
I think we can go back to that one in terms of, the surprise element. But I think, looking forward with the approval, yes, it does resonate. And there's 3 key points. I think the key one of the acquisition is their Barclays' strategic move to strengthen their retail market positioning. We know that there is a strategy to increase investment in the UK and to leverage Tesco's extensive customer base to enhance its service offerings. This is, second point, an opportunity to increase long-term revenue as well as customer acquisition in the retail space. There's billions in customer deposits and credit card accounts, also long-term play generally for revenue growth, because this integration provides the opportunity, better customer analytics, et cetera, for cross-sell of financial products from all those customers that have been loyal to the Tesco brand, if executed well, of course. And there is the, I think, just call out of Barclays' strength, financial and strategic, which includes the 23% rise in quarterly profits and shares hitting a 9-year high. I think this showcases clearly Barclays' financial health, but also how they're positioning themselves in the UK market. They're it's quite ambitious.
Absolutely. And Benjamin, on that point of kind of customer experience and loyalty, kind of taking in all those data points from Tesco's Clubcard and sort of baking that into Barclays, what does that look like? Barclays presumably have access to that data. What do you think they can do with it? What is the play here?
Well, do they? I mean, they have access to it with customers' permission, right? You can't just use data, right? Tesco can't just give all of its data to Barclays. You need some element of sort of customer permission and so on the Clubcard to say, okay, are you happy to receive financial offers? I mean, the other thing is, Barclays, like all large banks all around the world, it's been sitting on tons of customer data for decades and not done much with it. I'm being a bit unfair on Barclays. Barclays has actually, tried pretty hard to, show customers more insights from their data and so on. But I don't buy that suddenly having a partnership with Tesco and Clubcard suddenly is going to make Barclays into this firm that is able to do, astounding personalization and so on. I think this is primarily about economies of scale, as Mariela was saying. Barclays has got form here. Barclays has repeatedly picked up portfolios of business that have been for sale. They bought the business from Egg, which people with long memories will remember was a sort of early credit card and savings direct bank or digital bank. They picked up the business from ING Direct after the global financial crisis. And actually, this too is a legacy of the 2008 global financial crisis, because at that point, Royal Bank of Scotland, that had spectacularly overextended itself, had to sell off all sorts of assets because it was effectively bust. And one of the things it had to sell was Tesco Financial Services, which was a partnership with Tesco. Tesco, the retailer, bought it and then found, actually, this is quite hard to run. It's not really related to our core business. And all this kind of cross-selling promise actually doesn't work all that well. So I'm actually a little bit skeptical that this is really strategic for Barclays. I think it makes a lot of sense to take this pool of customers, put them onto Barclays' platform, strip out all the cost of Tesco running its own platform. Great. Can they make more of it than that? I don't know.
Interesting. And then equally, Barclays is still launching a range of financial services under the Tesco brand, which is interesting. So what would be the reason for doing that rather than putting it under the Barclays umbrella from the off, do you think?
Well, I guess you say, well, hey, Tesco's a different brand, right? It's very closely associated in British consumers' minds with value. Barclays is perhaps a little bit more upmarket. There's some advantages to having some differentiation, to offering multiple products under different brands. I mean, there was a time in the UK car insurance market where the top 3 of the top 4 car insurance brands were the same company, but people didn't know. So they seemed like, oh, look, it seems like more competition than there actually is. So yeah, if Barclays can come up with some clever, some clever tactics that makes it the proposition more relevant to Tesco shoppers, great. But if it's just, hey, you can have a mortgage with your courgettes or zucchini, how interesting, how compelling is that? So I think there's a lot of work to be done to really think about, okay, how do you make Barclays products more relevant to Tesco customers? Why should Tesco customers particularly want Barclays products? Why is that more relevant to me as a consumer?
The Tesco Bank customers, right? This is not just Tesco retail. These are the existing Tesco Bank customers.
Indeed, absolutely. But so for them, yes, this is potentially good because potentially the Barclays products are maybe slightly better or slightly more sophisticated than the Tesco Bank products. And that's kind of the point about shifting off the Tesco Bank platforms onto the Barclays platform. So potentially for them, potentially this is good news. But for people shopping in Tesco, that logic of buying your financial products in your retailer, it works quite well for certain types of insurance, but it's a tough sell for the more complex financial products like wealth or mortgages and so on.
And insurance is one of the products Tesco are actually holding on to as part of this as well.
Because it makes more sense.
Yeah. Mariela, on the sort of operational side, obviously integrating sort of one business into the other, what are the sort of challenges that you can foresee, or indeed the opportunities in terms of how Barclays might kind of bring Tesco on board?
I think it's more on the opportunity side, because when you look at the transaction details as well as the financial performance on the back of it, it's because of that synergies case. So there is, of course, the upside potential from the integration, additional revenue, monetization of those relationships, and potential for cross-sell. Now, this all sounds very strategic and hypothetical, but bear in mind that the team in Barclays, the innovation team, will have put together plans in order to sort of convince the skeptics, back it up with data, and they'll have some robust plans. I'm not privy to those, but you can see, in these transactions that they will be heavily challenged to come up with something that is robust. But the key thing was going to be now on the synergies case, and the acquisition by Barclays, the strategic move, to, as I mentioned, to strengthen the positioning overall. But the 3 key challenges will be around 3 angles. And typically it's around the technology, systems and data as one bucket. I know it's very complex, and when I mentioned those 3 things are one in itself. Also the people aspect, and then lastly the culture. the tech systems and data integration will have significant financials attached to it, with the opportunity to modernize, streamline banking operations, integrate systems. And then the challenge, of course, when you integrate disparate systems is also quite significant. The data component, as you alluded, Benjamin, is quite substantial, not just from the regulatory data privacy aspect, but just bringing in general data migrations tend to be quite challenging. Now, Barclays has flexed the integration muscle multiple times, so I have no doubt that they will execute a phased approach, focusing on maintaining uninterrupted customer service and gradually implementing after key risks are being mitigated and projects are mature towards migration and into production. On the people side, I think we're talking about say only, but I'm going to get into trouble. 2,800 Tesco employees joining Barclays. In my experience with M&A, this is an area where transformation teams or integration teams shine in terms of taking into account key talent retention, management of potential redundancies, packages, comprehensive leadership and management strategy, clear comms, and support to keep the productivity morale. These are all things that come with these types of migrations. And again, something that Barclays has done multiple times, and they'll have a seasoned team looking after this. Cultural is the challenging one in any integration. I wouldn't be surprised actually if, just because of the size of the UK market, everybody knows each other and everybody has been somewhere before. So I wouldn't be surprised if Tesco employers were actually previous Barclays employees, or they were either in one of the high street banks before, because that's just what tends to happen here. But yeah, there could be significant challenges, but also an opportunity for more customer-focused banking model. Ultimately, I think for these types of integrations, it will be a question about how Barclays leverages the Tesco Bank's customer service expertise while maintaining its sort of operational excellence and standards. How do you bring those two together?
I guess we'll find out. Jason, I just want to give you a very quick word on this as an American in the Netherlands looking at these two big British brands. What's your take on this?
No, I mean, I think the sort of synergy or economies of scale story makes a ton of sense. I mean, we spent some time in the BNPL story talking about distribution. What is Tesco beyond sort of that brand segmentation that Benjamin was talking about, as well as distribution. And just despite the increased competition we've seen with fintech, the overall trajectory, not just in the UK, but in many markets, does seem to be around, consolidation around a couple of very large banks. You see that in pretty much every market developed or developing, with the US being the weird outlier there. So it certainly makes sense based on what we've talked through today.
Absolutely. And we'll see how they get on, I suppose. And I'm going to move us on to our next story, which is that Mexican banking fintech Klar, importantly not Klarna, aims for 2026 IPO. The story was in payments. So Mexican fintech Klar is planning to go public by the end of 2026, targeting an annual revenue run rate of $500 million by next year's third quarter. Their services, including credit cards and savings accounts, cater to Mexico's middle-income professionals and students, aiming to reach 10 million users in 5 years in a country where only a third of adults have formal credit. With the majority of Mexican adults still relying on cash, companies like Blue Financiero and Aviva are also stepping in, showing a high demand for inclusive financial solutions in Mexico's underbanked market. So Benjamin, what do you make of this? Obviously, there's a huge unbanked population in Mexico, around sort of 50%, but that isn't actually who Klar is targeting here. They're looking at the sort of mid-tier kind of financially stable adults by the looks of it, middle income.
Yeah, I was just thinking, how much sort of perceptions of digital banks have changed, because when digital banks first launched, people weren't really taking them seriously and people were very dismissive of them and saying, hey, this won't work and so on. And now everyone's saying, I wish I'd owned, a tiny stake in Revolut or Monzo or whatever. And, so the huge success of firms like Tinkoff in Russia or Nubank from Brazil and WeBank in China and so on has shown the enormous potential to deliver better banking services to people in growing economies. Mexico's a big country. It's the I'll get corrected if I'm wrong. I believe it's the third largest country in the Americas. So United States, then Brazil, and Mexico. It's a big country, a lot of people. That's a huge, huge market. It's really hard to get.
Jason's nodding. You're safe on that one.
Good. It's hard to get lots of growth in Paraguay or Uruguay or wherever because not many people live there. Mexico's got a big, educated population. Yes, there are some challenges in that country. Like many countries. But I think that's really exciting. And of course, the middle classes are, the people who are most aspiring. It is tough bringing the unbanked into the market. That's a very low margin business. Where that's worked really well is firms like WeBank in China. Off the or my bank off the back of social media networks. Now, if you haven't got that, if you haven't got a social network, you haven't got really low cost, then actually, the middle classes are a better bet. If you can provide them with better services than the established banks, there's a huge opportunity there of people who are not only trying to improve their own lives, but potentially setting up businesses and so on. That's a super exciting market that's often quite badly underserved. So I think it's a really, really exciting story. And the challenge for them is, can they move fast enough to stay ahead of Nubank?
Yeah, that's probably the challenge all over in LATAM, probably. But Jason, you were nodding throughout that. What's your take?
Yeah, there's certainly some very interesting and idiosyncratic aspects to banking and financial services, in particularly like consumer retail in Mexico. So, one of those is the very stubbornly high use of cash for payments, particularly outside of the largest cities like Mexico City or Guadalajara. That ticks and ties to the high rate of underbanked or unbanked underbanked. So, the two largest economies in LATAM are Mexico and Brazil. So it can be interesting to sort of look at certain metrics between the two countries and try to understand what is driving the delta, right? Everyone in fintech loves to talk about Pix, the Brazilian instant payment network. It's so successful, et cetera, et cetera. The rate of unbanked in Brazil is still high by developed international standards at about 20% that do not have access to a bank account. But as you pointed out, in Mexico, it's about 50%. One of the major reasons for that, which is quite challenging for a fintech or bank to sort of answer, is tax avoidance, right? And if you're operating in cash in the Mexican economy, one of the main reasons why you're doing that is to avoid the Mexican tax authorities. And one of the ways that shows up from a product and a distribution perspective is, arguably the most successful fintech in Mexico is OXXO. If you've not been to Mexico, OXXO is a convenience store comparable to 7-Eleven. Why is that physical footprint? And you can barely walk a block or two in Mexico City without seeing an OXXO. It serves as a point for cash in, cash out. And so if you're a purely digital distribution fintech, there's large chunks of the market that it's going to be very difficult or impossible to serve if they're getting paid in cash and if they prefer to transact in cash, but you don't have that physical footprint to facilitate cash in, cash out at a physical point of sale. It's going to be very challenging to serve that audience. And I think that's why, as you described, Klar is aiming for a more middle-income professional student customer segment, as opposed to a more working class, working poor segment who may work in the informal economy, be compensated in cash, and thus have sort of different payment needs than somebody in this sort of more middle income segment.
Yeah, absolutely. And sort of building on that point, so Klar is banking, no pun intended, on a growing middle class and student population to grow from 2 to 10 million customers in the next 5 years. And the middle class population is about 45% of the Mexican population, which is expected to keep growing and add over 3 million households to that range by 2030. So that's like quite a big growth in that economy, relatively speaking. Obviously, there's a lot of unbanked as well. Do we think that signals like a good sign or just a greater divide?
I'm going to say what's cause and what's effect here. I mean, one of the best things about fintech, one of the things I love about fintech is the way that using technology to lower the cost of distribution has enabled companies all around the world to bring people into the formal economy, to give them digital money or give them access to sort of all sorts of new sources of financing. So, there's an element to which the growth of the middle classes in countries all around the world is being partly enabled by fintech. So you're right, it's good for fintech, but it's also enabling fintech. Does it create a divide? I think you get a digital divide where people don't have access to technology. I don't know that fintech in and of itself creates a divide. I mean, to the point Jason was just making, people are choosing not to expose all of their finances to the tax authorities in some countries. So what fintech is doing is it's giving people more choices. It's giving them more options. And anything that gives people more choices and more options is generally good for people and good for the economy.
Except for if it's too many options at a buy now, pay later checkout. Mariela, is there anything you would like to add to any of those points?
I think it's pretty comprehensive, so I won't add any more. I'm looking forward to the next topic.
Absolutely. Okay, now for a quick look at one more news story this week that we don't have time to cover in full, which is that NatWest and Mastercard have launched a mobile virtual card solution for businesses. Story in the Fintech Times. So, in quotes, approval to buy with mobile virtual cards is a mobile virtual card payment solution that allows companies to issue virtual cards for employees, reducing reliance on physical cards for corporate payments. The solution enables finance teams to set budgets, control usage timeframes, and restrict where cards can be used, creating greater flexibility and control over employee spending. Virtual cards can be issued instantly and used for online and tap and go payments via digital wallets. The article goes on to say that the virtual card service is particularly useful for temporary workers, business travelers, and situations requiring immediate payments, reducing the need for personal card use and simplifying expense reporting. The partnership uses Mastercard's tokenization technology to protect sensitive data and improves data security while providing easy access through a single interface. To find out more about this partnership, we spoke to Johanna Waara, Senior Vice President of Commercial Solutions Europe at Mastercard.
Digitization in payments has been happening for a long time across Europe. As consumers, we have increasingly come to expect fast, secure, and frictionless payment experiences with just a click or a tap. And similarly, businesses too are now seeking the same flexibility, simplicity, and security for their corporate spending needs. We are really excited to be collaborating with NatWest Group to support these changing customer needs through the launch of our new mobile virtual card app to businesses of all sizes across the UK, enabling them to provide virtual cards to their employees for the use across the globe. These corporates can now offer a secure card solution to their non-carded employees. Whether it's for ad hoc travel, marketing, or event spend, or even office supplies, employees simply request a single-use virtual card number, and once that is approved by their manager or finance department, that virtual card is pushed to their mobile phone, and it's ready to make an in-store purchase or online payment. After the transaction, the virtual card number expires, but the rich data from that purchase or purchases is automatically sent to the expense solution used by the corporate. So in other words, a true consumerization of corporate payments.
There we have it. Congrats to both NatWest and Mastercard on that partnership. And finally, a look at something a bit more lighthearted from the world of fintech. And this week's story is Johanna completes world's first interspecies money transfer. That last bit was in inverted commas. Johanna, an African-based startup, has just completed the world's first interspecies money transfer, linking digital payments directly to gorilla conservation in Rwanda. Using AI, Johanna's platform assesses the needs of the gorillas, and conservation agents earn income by completing tasks based on these insights funded through mobile payments. This innovative approach partners with Rwanda's Ministry of Finance, aiming to protect mountain gorillas, which hold an ecological value of $1.55 billion. Johanna's project seeks to set a new standard for conservation funding, leveraging technology to enhance biodiversity and conservation data. All right. Be honest, who had to double take when they read this headline versus this story? Can someone explain this one to me at all?
I think it's a poor title for a really important thing. If you want to create conservation, the people who live around the thing that's being conserved, whether it's an old building, whether it's a species, whatever it is, a game reserve or whatever it is, the people who live near there need to benefit from that in some way. And so if Johanna is finding a way to help people who live in Rwanda, who live near where the mountain gorillas live, to benefit from the gorillas being there rather than cut down the forest and plant crops or whatever it might be, then that's brilliant, because the only real way to get conservation to work is to get local people to benefit from maintaining biodiversity. Because, the problem we have, the problem of the commons is that individuals can sort of damage the planet and don't pay the cost for that. So you have to reward people for protecting the planet. So I love this. I think the title on the article is terrible, interspecies money transfer. But hey, if that got us to pay attention to it, great.
It got my attention. I perhaps didn't fully understand what was going on here and who was paying who, but
the gorillas are not involved in the transaction. Let's just be clear.
A real shame. But do we think this is a great example of like real fintech for good?
Yeah, I definitely think it's an example of the power of payments and a sort of a very specific and perhaps niche use case, but certainly a feel-good story to cap off this episode with, which I need.
Yeah, absolutely. Mariela, what was your take?
I'm huge on animal protection, wildlife preservation, and biodiversity, also conservation. So I love this. I don't know, as somebody who is deep into developing AI cases, how you solve for this one and how they did it. I'd be very intrigued to learn how. But as somebody who's spent, I think, a big chunk of my life giving, donations to a lot of animal preservation, I tend to disagree a little bit with you, Benjamin. I think it's directly about the animal welfare, and seeing that the animals are being protected from potential threats, hunting, or the preservation of their environment. I don't know how they come up with the number of 1.55, but I dare say it has to do with donations, the people that are associated with managing those donations and ensuring the protection of the wildlife. If there is a way through the payments to increase or add on fees or some sort of additional incentive that is going to contribute towards the preservation of their the gorillas and their habitat, I'd be signing up, and I wouldn't mind the additional fees if this is proven. And this is, I guess, the question: how do you implement AI to assess the needs of gorillas? That's a big question for me. And second, where does this 155 come from? So assuming those two things are solved, I'm in.
My assumption is that the $1.5 billion calculation is the value of sort of tourism and so on to Rwanda, that people coming in from other countries into Rwanda and so on, is having those gorillas makes Rwanda a more interesting place for some people to visit than it would be without the gorillas. I'm not
Is that an ecological value though? Or is it more a value if you took the gorillas out, what the loss to the ecosystem
but also,
would be?
Yeah, but I suppose also that, those gorillas are the sort of apex of a much more complex ecosystem. It's not just the gorillas, that's not the only thing that's there. Mariela, I don't think we do necessarily disagree. My point about was not that the welfare of the animals and the biodiversity and so on isn't important. I was simply saying that to support conservation, it helps if the communities around there are involved in that and appreciate the asset that is being protected. Some people appreciate things just because God put them on earth. Other people appreciate them because they have a direct benefit from them, or because they're beautiful or whatever it is. But I don't know that we completely disagree. I think we're all agreeing. Anything that enables and supports conservation is only to the good.
Absolutely. And I have a slightly silly question here to end on, but if we were to give you £100 to pick one animal that you would send money to, I know we've discussed the gorillas, are not necessarily receiving a payment themselves, but what animal would you pick and why? Jason?
Yeah, when I read the headline of the interspecies money transfer, the first thing that occurred to me was, don't I do that all the time? Because my dog takes all my money. So I guess if I have 100 quid, it's going to my dog.
Brilliant. Mariela?
Same like Jason, I would dare say she takes the 200, but at the same time, because a lot of what I do is to donate for animal preservation, I guess I'm doing it anyway. But I didn't think about actually how much is going to my dog. I think that just goes by default.
And Benjamin, you're a cat owner. Is that your answer? Or have you got a better one?
No, my answer is bees, because I'm extremely concerned about the decline in insect populations. If you look at the number of insects that are around now compared with 30, 40, 50 years ago, there's been enormous loss of insects. And bees are, a little bit like the canary in the coal mine. They're one of the first species that really, really suffering. There's lots of diseases and so on that are afflicting bees. So bee populations are really suffering, which means pollination of plants is suffering, creating exactly the kind of habitat destruction that Mariela has been talking about. So I think it's easy to focus on the big animals like the gorillas, but actually it's often the little ones that we don't notice disappearing that is the bigger threat to life on Earth.
Very deep.
But £100 is nothing like enough. So, you need more like 100 million.
Yeah, that wasn't on offer, unfortunately.
I realise that. I'll take the 100, but 100, let's be clear, 100 is not enough.
Not scratching the surface. And on that note, that wraps up this week's Fintech Insider News. Thank you so much to today's guests. Where can people find out a bit more about you and your companies? Benjamin?
Well, by definition, listeners have already discovered 11FS because you're listening to the podcast. But you can find out a little bit more about me, Benjamin Ensor, on LinkedIn, or you can find out more about what the ventures team is up to at 11fs.com.
Thank you. Mariela?
Yes, connect with me on LinkedIn, Mariela Hunter, and especially if you're interested in automation, implementing AI agents. I did build an AI agent as M&A agent as well. And if anybody's interested in the world of fractional leadership, impacting multiple companies as well, I want to give a shout out to fractionalshq.com.
Thank you. And Jason?
You can find me on LinkedIn, Jason Mikula. Subscribe to the newsletter at fintechbusinessweekly.com, and you can learn more about Tactile at tactile.com.
Fantastic. And as for me, very similar to Benjamin, you can find me at 11fs.com on this podcast or Laura Watkins on LinkedIn. Thank you so much for listening. If you like what you've heard, please follow our podcast. And if you really want to help us make a better show, you can do so by filling in our listener survey right now at 11fs.com/survey. And if you're listening on Spotify, you can now drop us a comment and tell us what you thought of the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or email me and my team, podcast@11fs.com. And we also have a brand new WhatsApp community channel where you can get the inside track on all of our content. You can get involved via the link in the description below. Thanks very much, and goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.